Welcome back, traders. This is your weekend recap of the stock market, and in today's video we are going to be discussing a few key important ideas that we all need to consider going into the last trading week of August. As we know, September is generally the weakest trading month of the year on a seasonal standpoint, so that is one of the few things that we're going to be discussing on this video today. So if you haven't already, please go ahead and leave a like down below to help out with the algorithm. Also, go ahead and subscribe to the channel, that way you're not missing out any of our videos whenever they're released. And if you know anybody that would find this video useful, please go ahead and share this video, we would greatly appreciate it. Without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in, get yourself a drink, sit back and relax. Now let's get right into it. Now, as we know, for the past few trading weeks, we have definitely created a downtrend where we have lower highs and lower lows. So that in its sense of itself creates a downtrend market. So we are seeing the same effect across all the other major indices such as the S&P 500 and the Dow Jones. We have the Dow Jones, which was generally the weakest of the bunch for the entire year, that has created a downtrend, and we are in that mode of complete sell-off. But there are a few things that we need to consider just looking at where we are in this current downtrend. Now, just to give you guys a recap of how far down we are from the highs, looking at the S&P 500 from top to bottom, we are down 3.89%. Looking at the triple Qs, we are down 5.61%. And looking at the Dow Jones from top to bottom, we are down 3.6%. So in a sense, we have created a correction on the triple Qs, which is currently down 5%. The S&P 500 from the top to its lowest point of this downtrend came close to a 5% drawdown, but it hasn't hit it just yet. So there's certain markets that are out there that are in a correction territory, but generally if you look at the underlying stocks that make up these ETFs, you can ultimately consider that we are definitely in a downtrend and in a correction territory. Just by looking at Apple alone, we are down from top to bottom. We're taking this high here to this point here. This is a 13% correction, and currently for its Friday close, it is a 10% correction. All right, so it recovered roughly around 3% from from the bottom to where it currently closed for the week. So now with that to consider, right, we have to look at certain indicators that will give us an idea of where this market is going. So looking back at the S&P 500, right, we have what I have here is the moving averages. Right now we are below the daily moving average, the 50 moving average, and the 15 exponential moving average. So that is generally a negative standpoint. However, we have created a higher low, which is also a good sign of a recovery. So, but we haven't clearly defined a higher high just yet, right? So we're gonna need some sort of higher point from here, and hopefully we can get to 450. If we get to that point, then we can ultimately, start a new trend of an uptrend, right? Once we can see this take place, then we could switch our bias to a more directional standpoint. But as of right now, we have a downward sloping exponential moving average, and we're currently below the 50 exponential moving average. Looking at the MACD, we have a slowdown of momentum, right? Well, when we saw this crack between the moving averages on the MACD, where the blue line fell below the yellow line, we pretty much got bearish and started to open up a lot of call credit spreads, which is a bearish trading strategy. When we opened that up, we profited on the downside, and we made money on the move down. But now that this MACD has slowed down, we are switching over to a more neutral trading strategy, and we'll be discussing that towards the end of this video. So with that in mind, I just want to point out a few things here. Right now, we are in a neutral standpoint between fear and greed, looking at the fear and greed index. And when we are in a neutral standpoint, we can't be very directional in a sense of our trades because the market could move either way and it could pretty much be range bound. And when we are in a range bound environment, you want to switch up your trading strategy. You want to switch up to a more dynamic style of trading where you are picking your trades on a more fluid strategy where we could make money trading to the upside and make money trading to the downside whenever the market turns the way it turns. Now looking at the seasonal S&P 500 tracker that we have here, this is a collective history of how the market pretty much traded throughout the years. And with these data points, we can see that September is generally the weakest trading month of the year. So what we can expect, as we know that on Thursday, Friday of last week's trading sessions, we saw a run up in the market, right? And the market, moved up towards the end of the trading week, and we might see a continuation of that going into September. But ultimately, you see this big drawdown here. This is just a collective data of where it points out that the market, sometime in mid-September, will experience some sort of drawdown. So that is something that we all need to consider going into September, right? We may have some bullish trading opportunities going in from the end of August into September. But once we get around that mid-September trading session, we need to be very careful looking for those entry points where we could possibly start to put up more hedges to the downside or possibly take a bearish trading position. So that is something that we are going to be looking at going forward that we all need to be considering. Now, looking at the trading economic calendar, what we have here are few key important dates looking into September. So what we have here is obviously on Wednesday, September 13th, we have the CPI data that's going to be released, right? And inflation data that's also going to be released. These are important things that we all need to consider. Additionally, we have the FOMC rate decision. This is going to be huge because, as we know, during the Jackson Hole event with Jerome Powell, he was pretty much hinting that they are ready to impose more rate hikes. With more rate hikes, that is generally bearish for equities, and that could manifest the idea that sometime mid-September, we are going to be experiencing that sell-off towards the end of September. And then after that, then it's going to present us a good buying opportunity to rally into that Santa Claus rally all the way from October through the end of December. So that is something that we are forecasting for this trading for the remainder of the year, really. 2023 has been a remarkable year with a lot of gains to be realized. And so we are going to be looking for these types of opportunities going into the end of August, beginning of September, and throughout the end of the year. Now, going back to the charts, right? So as I pointed out earlier, right, we are monitoring a few key important ideas, right? So we know that obviously the market traded, also looking at the Qs, the market traded right below the 15 and the 50 exponential moving average, which is generally bearish, right? You're going to see more bearish trading, a lot of rejections, and very few breakouts, right? As we saw here on Thursday, the market traded all the way up to 370 and it rejected at this point. And you could see that the market really respected this 372 area. If we look at the weekly chart, you can see how the market was really respecting this level here, back here in March of 2022, and this range here in January of 2022. And then you saw a little bit of a resistance back here, back in 2021 of July through August, right? So the market is respecting these levels. So we also have to be very careful whenever we are trading around this level. If the market trades up to this point, it could ultimately mean that it is where bearish traders are placing their hedges or even taking that bearish standpoint to exit out of this sell-off, right? Because any hedge fund manager is going to move the price up in order to create liquidity, in order for it to sell off their positions for a more favorable price. So that those are things that we all need to look at, right? And obviously we have this weekly crossover on the MACD, which is ultimately presenting us a bearish momentum. But again, if we look at the daily price action, we are seeing a slowdown in the MACD of uh, this this oscillator. So whenever we have a sideways action of these moving averages on the MACD, that is generally a sideways price actions that we could expect on the price movements of the underlying instrument. So again, if we're trading the S&P 500 or the triple Qs, we need to be looking for a range-bound environment, which points me to the idea that this is probably a good opportunity to be a more dynamic trader at this point, where we could really trade the price levels, right? When the market moves up, you want to open up call credit spreads. When the price moves down, you want to move into a put credit spread opportunity because when volatility picks up, you can definitely open up far, far below contracts to collect good premium. Now, lastly, before we go into the trades of opening up a dynamic trading strategy or even an Iron Condor, we want to look at the VIX, right? So as we know, the VIX is very important, especially when it comes to option trading, because the VIX volatility ultimately uh, prices in the price of contracts. And so it's good to always refer to this whenever we're trading options. Now, looking at the VIX, this is the daily chart. We can see that we created a higher low and higher high. This is definitely still in an uptrend um, for the VIX. So we need to be monitoring this very closely. So anywhere from 1560 all the way down to 15 is going to be an area of bottoming for the VIX. So we have to be very careful if we are buying when the VIX is low, since we are currently in this range. You want to be very careful buying equities when the VIX is near the bottom of these channels, because that could be an opportunity where the market will sell off and the VIX will pop once again. So just looking at this, we are in the bottom range channel. We haven't hit the 20 yet on the VIX. We might not get there depending on the underlying sentiment of the market, but we just have to look at this as a guideline of understanding where volatility is in the market. Now, again, if we crack below 15, that might be a signal that the bearish sentiment has ended, which would mean that stocks such as S&P 500 or the triple Qs is going to generally move higher, and we might cap it at 15, which would be the new uh, the new top if the VIX falls below. So that would be good for the markets, and the markets would rally higher as a result of a lowering VIX. Now, looking at the trading strategies, one idea that you can do uh, when we are in this neutral environment where the market is, trading in a range-bound environment, one way to do it is by trading dynamically. What I mean by trading dynamically is you have to be very careful as far as watching where the market is trading. Going back to the triple Qs, we see that we created this top at 337, and we have sort of a bottoming range of anywhere from 358 all the way down to 354, right? So within this range, we could create a dynamic strategy, but we have to do it in whenever the price is either at the upper range or at the bottom range. When the price moves to the upper range, that's when you want to start opening call credit spreads. And the way to do that is to first look at the call side, then you want to sell a strike that is out of the money. So in this case, we are looking at 377, and then we would want to buy 5 points higher, which would be 382. Whenever we do this, we are creating a call credit spread. The nice thing about this is that once you have this trade open, we are now looking for the market to sell off. And when the price moves down, that is when we are going to start looking to open up a put credit spread. So the idea is that once this trade is already in, we are then going to be waiting for price to move down. And when price moves down, we are going to be opening up a put credit spread. And the way to do that is to go to the put side and you would sell a contract. So in this case, we're going to choose the 350 and then we're going to buy the 345, 5 points lower. When we do this, we are opening up a put credit spread. And because we can do this, it is allowing us to finance these contracts without utilizing more buying power because we already had that call credit spread placed in. So that is a unique way of trading dynamically, but you're really watching price in order to open up these contracts. But if you want to trade a little more passively, one way to do it is by opening up an Iron Condor. And to do that, you're just literally just opening it up all at the same time. So the way to do that, you would open up a call credit spread. So you're selling the 380, opening up the 385. You're selling the 380 and buying the 385. Then you're moving down here and you're buying, or I'm sorry, you're selling the 345 and you're buying the 340. Once you do this, you're opening up a Iron Condor. This is a trade that you put in at the exact same time, and when you want to close it, you're closing it all at the exact same time. So it's a 4 contract strategy, 2 on the calls, 2 on the puts, and that creates an Iron Condor. And all you're doing at this point is waiting for price to bounce between your 2 sell strikes, which is 380 and 345. And let's look at where that is on the triple Qs. 380 is all the way up here. And then what do we have on the puts? On the puts, we had 345. So let's just use this point here. So we're looking at 380 and then 345. Right, that's what we had here. And so now what we are doing is watching for price to bounce between this range because we have the assumption that the market is going to trade sideways. And the cool thing about this is that as time passes, right now this is a 12-day to expiration contract, an Iron Condor that we're opening up for September 18. If the price trades in between this till the end of expiration, we collect this entire net premium, which is a max profit of $59. The max loss is $44 or $441. So that is more than a 10% return on your money. And this is what's unique about this. You're trading probability. The probability that this contract is going to expire worthless by the end of September 8th. And look at this. This is the out of the money percentage, which is, giving us a number of a 93% probability of profit, and a 93% probability profit that this would remain out of the money by expiration within 12 days. So that is really cool. That's the cool thing about a neutral market when the market just trades sideways. You could trade these odds, especially because volatility is, higher in these sell-offs. And as we're coming out of a sell-off, we can expect to see volatility collapse. And this is a perfect trading strategy. This is a perfect trading strategy if you're going to play a neutral market. So that is what I have for you today. Again, watch out for these key important dates that we are going to be seeing in September, so that way you can all be prepared for the next trading session. So thank you all for tuning in. We will see you on the next one.